Most traders hear the phrase, "the trend is your friend," early in their journey, but almost none of them truly understand it. They repeat it like a slogan, they write it in notebooks, they put it on wallpapers. Yet, the moment price looks too high or too low, they betray it. This chapter is not about memorizing the phrase. It is about understanding why the trend exists, who creates it, and why fighting it is a slow financial suicide. The market does not trend because of indicators. It does not trend because of news headlines. It trends because large institutions need direction to efficiently execute size. Banks, hedge funds, and algorithmic execution models cannot operate in chaos. They require sustained movement to accumulate, distribute, and rebalance positions without exposing their intent. That sustained movement is what retail traders call a trend. A trend is not a line on your chart. A trend is a delivery mechanism. When institutions want to accumulate long positions, they do not buy randomly. They engineer conditions where price can move higher over time, allowing them to enter on pullbacks, rebalance risk, and continue building exposure. The same logic applies when they want to distribute or short. This is why trends persist far longer than logic would suggest. Not because price is overbought or oversold, but because the objective has not yet been fulfilled. Retail traders lose money because they assume the market exists to offer them fair prices. It does not. The market exists to facilitate large transactions efficiently. If you understand this, the trend stops being mysterious. It becomes obvious. Let us deal with the hard truth early. You are not smarter than the trend. Every trader who tries to fade a strong trend believes they have found an exception. They believe they are early. They believe they see something others do not. In reality, they are reacting emotionally to extended price. They feel discomfort buying high or selling low, so they justify counter-trend positions with stories. Indicators help them tell those stories. Divergence, RSI extremes, Fibonacci levels pulled from irrelevant swings. None of it changes the core fact. They are trading against institutional intent. A trend represents agreement between time frames, agreement between liquidity flows, agreement between accumulation and expansion phases. When you trade with the trend, you are not predicting, you are aligning. That distinction matters. Prediction requires ego, alignment requires humility. The market does not reward ego. One of the most damaging habits retail traders develop is the obsession with tops and bottoms. They want to be right first, not right consistently. Catching a reversal feels intelligent. Riding a trend feels boring, but boring is profitable. Professionals are not in this business to impress themselves. They are here to extract money repeatedly with minimal emotional exposure. Think about how trends actually move. They do not move in straight lines. They expand, retrace, consolidate, and then expand again. These pullbacks are not reversals. They are opportunities engineered to attract liquidity. When price retraces in an uptrend, it invites sellers. Those sellers provide buy-side liquidity for institutions to add long positions. Every failed sell in an uptrend strengthens the trend itself. This is why counter-trend traders feel constantly almost right. Price reacts, it pulls back, it hesitates, but it does not reverse. They confuse reaction with reversal. Institutions understand the difference. The trend remains intact until market structure shifts, not until price feels uncomfortable. A higher high followed by a higher low is not random. It is confirmation that demand continues to overwhelm supply at progressively higher prices. Until that behavior changes on the relevant time frame, fading the move is nothing more than gambling disguised as analysis. Now let us talk about time frames, because this is where most traders sabotage themselves. A trend only exists relative to a time frame. Price can be bullish on the daily chart and bearish on the 5-minute chart. This is not a contradiction. It is hierarchy. Institutions execute across multiple timeframes, but they respect higher timeframe direction. Retail traders often anchor themselves to low timeframes because it feels active. It feels like control. In reality, it disconnects them from the true narrative. If the daily and 4-hour charts are trending higher, Selling on a 5-minute chart is not smart scalping. It is swimming upstream. You may survive briefly, but eventually the current overpowers you. The market does not care how good your entry looks if it contradicts higher time frame flow. This is why experienced traders begin analysis from the top down. Not because it is a rule, but because it aligns them with the dominant force. When you know the higher time frame trend, every lower time frame setup becomes clear. You stop asking, can price reverse here? And start asking, where is price likely to retrace before continuing? That shift in questioning changes everything. Trends are sustained by liquidity objectives. In an uptrend, the market seeks sell-side liquidity to fuel higher prices. In a downtrend, it seeks buy-side liquidity to fuel lower prices. This is why trends often accelerate after breaking obvious highs or lows. Those levels are not resistance or support in the traditional sense. They are pools of resting orders. When price breaks above a high in an uptrend, it triggers stop losses from sellers and breakout buys from late participants. That sudden influx of orders allows institutions to either add or distribute positions efficiently. The trend benefits either way. This is why buying breakouts in strong trends works far more often than logic suggests. It is not about the breakout, it is about the liquidity it unlocks. Retail traders are taught to fear buying the top. Institutions rely on that fear. They know most traders will hesitate at highs. That hesitation creates imbalance. When price trades above a prior high and holds, it is a signal that demand remains dominant even after liquidity has been consumed. That is strength, not weakness. The trend is your friend because it reveals intent. Intent is the only edge that matters. Indicators lag, patterns fail, news is interpreted after the fact, but intent leaves footprints. Higher highs, higher lows, strong closes, shallow retracements, aggressive expansions. These are not coincidences. They are the result of sustained participation from players who cannot exit quickly. Another uncomfortable truth: trends are maintained by traders like you losing money fighting them. Every stop loss hit against the trend is fuel. Every margin call is confirmation. The market is not cruel, but it is efficient. It transfers money from emotional participants to disciplined ones. This is why patience is not optional. Trends reward traders who wait for pullbacks, not those who chase every candle. But waiting does not mean doubting. When you are aligned with the trend, a pullback is not a threat. It is a setup forming. Most traders panic during retracements because they entered without understanding context. They bought because price was going up, not because the market structure supported continuation. When price pulls back, they assume they were wrong. Professionals assume the market is offering better pricing. This difference in perception is the line between amateurs and professionals. The trend does not guarantee profit. Nothing does. But it stacks probability in your favor. Trading against it stacks probability against you. Over time, probability always wins. Not in one trade, not in 1 week, but across hundreds of executions. You do not need to be perfect. You need to be aligned. By the end of this series, you will understand how to define the trend properly, how to enter within it with precision, and how to manage risk without emotional interference. But none of that matters if you do not first accept this foundational truth. The market moves with purpose, and that purpose expresses itself as trend. Fight it, and you will spend your career trying to prove you are right. Align with it, and the market will do the heavy lifting for you. Defining the trend correctly, or why most traders are trading the wrong one. Before a trader ever places a trade, there is a silent decision being made, often unconsciously. That decision is not whether to buy or sell. It is which version of the market reality they are choosing to operate in. Most traders think they are trading the market. In truth, they are trading a fragment of it, usually the noisiest, least reliable fragment. The trend does not exist in isolation. It exists within time frame hierarchy. If you misunderstand that hierarchy, you will consistently believe the trend has changed when it has not. Or worse, believe a trend exists when you are only seeing noise. Let us strip this down to fundamentals. A trend is not defined by a moving average. It is not defined by an indicator crossover. It is not defined by how many candles are green or red. A trend is defined by price delivery relative to structure on a specific time frame. This is where most traders fail. They look at a 5-minute chart, see price moving up for 30 minutes, and declare an uptrend. Meanwhile, the daily chart is delivering lower highs and lower lows, and price is simply retracing into premium before continuation lower. The trader is not wrong technically, they are wrong contextually. And context is everything. Institutions do not ask, is price going up right now? They ask, where are we within the higher time frame dealing range? That single question eliminates most bad trades. The market moves in fractals, but not all fractals are equal. Higher time frames carry more weight because they represent more transactions, more capital, and more commitment. A 5-minute move can be erased in seconds. A daily trend cannot be undone without massive participation. This is why professional traders always start from the higher time frame, not to predict, but to establish directional bias. Bias is not a trade. Bias is a filter. It tells you what to ignore. If the daily trend is bullish, your job is not to find sells. Your job is to wait patiently for buy opportunities. That patience feels like inactivity to an undisciplined trader. To a professional, it is restraint. Most traders sabotage themselves because they want to trade all the time. They believe more trades equal more money. In reality, more trades usually equal more mistakes. The trend acts as a governor on your behavior. It limits your activity, and in doing so, it protects your capital. Now, let us talk about structure, because structure is the language of trend. In an uptrend, price delivers higher highs and higher lows, but that statement alone is incomplete. What matters is how price reacts at previous highs and lows. Strong trends show respect for prior structure. Pullbacks are shallow. Expansions are decisive. Closes occur near highs in bullish trends and near lows in bearish trends. Weak trends, on the other hand, show hesitation, overlapping candles, deep retracements, slow expansion. These are not environments for aggression. They are environments for patience or avoidance. Retail traders often mislabel consolidation as reversal. They see price stop moving aggressively and assume the trend is over. In reality, institutions may simply be rebalancing positions. Trend termination requires structural failure, not boredom. A bullish trend ends when price fails to make a higher high and then breaks a prior higher low with displacement. Until that happens on the relevant time frame, the trend is intact. Anything else is speculation. Here is where ego interferes. Traders love to call tops and bottoms because it feels like mastery. Riding a trend feels passive, but passivity is not weakness. It is alignment. The market does not reward those who guess correctly once. It rewards those who execute correctly repeatedly. Defining the trend properly also means choosing the correct time frame for your personality and risk tolerance. A day trader should not be emotionally reacting to daily candle closes, but they must respect the daily narrative. A swing trader should not be entering trades based solely on 5-minute fluctuations. Your execution time frame does not define your bias time frame. This is a critical distinction. Institutions might use daily and 4-hour charts to define trend, then execute on the 15-minute or 5-minute chart. The higher time frame tells them what to do. The lower time frame tells them when to do it. Retail traders invert this process. They start with the lower time frame and then look for confirmation higher up. That is backwards. By the time they look higher, they are already emotionally invested. When you define the trend first, you eliminate emotional conflict. You are no longer asking, should I buy or sell? You are asking, is this a valid opportunity in the direction I already accept? Acceptance is key. You must accept that you will miss moves. You must accept that price will sometimes move without you. The trend trader is not chasing perfection. They are protecting consistency. Another mistake traders make is defining the trend using too short a look back. They focus on the most recent swing and ignore the broader structure. Institutions do the opposite. They zoom out until the narrative becomes obvious. Then they zoom in to refine entries. If you need multiple indicators to convince yourself of a trend, You do not understand it yet. True trends are obvious when seen correctly. They do not require persuasion. This does not mean trends are easy to trade. They are psychologically difficult because they force you to wait, to enter on pullbacks, and to sit through retracements without panicking. That difficulty is the barrier that keeps most traders unprofitable. Let us address pullbacks directly. In a healthy trend, pullbacks are not random. They often retrace into prior consolidation zones, inefficiencies, or previous highs and lows. These areas are not magical. They are zones where orders previously existed. Institutions return to these zones because they know liquidity is likely to be present. Retail traders often sell pullbacks in uptrends because the candles look bearish. They forget the larger context. A red candle in an uptrend is not a sell signal. It is information. It tells you price is seeking liquidity. The trend trader does not fear pullbacks. They prepare for them. Defining the trend correctly also means knowing when not to trade. Choppy markets are where trends are unclear or transitioning. These are the environments where patience is most valuable. There is no obligation to trade every day. The market does not reward participation. It rewards timing. When traders complain that the market is manipulating, what they are really saying is that they do not understand context. The market is not manipulating you. It is moving according to objectives you are not aligned with. Once you correctly define the trend, many questions disappear. You stop asking why price is doing what it is doing. You accept that price is delivering what it needs to deliver to continue. This acceptance removes emotional resistance. Emotional resistance is what causes early exits, revenge trades, and overtrading. A trader aligned with the trend knows they are not smarter than the market. They are simply cooperating with it. That cooperation does not guarantee wins. Losses still occur, but losses within the trend are controlled, rational, and recoverable. Losses against the trend are often emotional, impulsive, and compounding. By the end of this chapter, you should understand this clearly. If you define the trend incorrectly, everything built on top of that definition will fail. Entries will fail. Stops will feel random. Targets will feel unreachable. But when the trend is defined properly, even imperfect execution can be profitable. The trend is not something you hope for. It is something you identify, accept, and respect. And once you do, the market stops feeling hostile. It starts feeling structured. Pullbacks, liquidity, and Y trends offer safer entries than reversals. Most traders believe trends are dangerous because price is already moved. They feel late. They feel exposed. They feel like the smart money already made their profit. This belief is not only wrong, it is the reason most traders never experience consistency. Trends are not dangerous. Misunderstanding how trends breathe is dangerous. A trend does not move because price wants to move. It moves because liquidity must be accessed. Liquidity is not an abstract concept. It is the fuel that allows large participants to enter, add to, or exit positions without causing violent price disruption. Pullbacks exist because liquidity must be replenished. If price moved in one direction without pause, there would be no opposing orders. No opposing orders means no ability for institutions to transact size. So the market pauses, it retraces, it invites participation from the wrong side. That participation is then used to continue the move. This is the mechanism behind pullbacks. Retail traders interpret pullbacks emotionally. They see red candles in an uptrend and assume danger. Institutions see opportunity. They know that sellers entering during a pullback are providing exactly what is needed to continue higher. This is why trend trading is safer than reversal trading. You are not predicting a change in behavior. You are participating in continuation of existing behavior. Reversal trading requires precision. Trend trading requires patience. Most traders fail at patience. A pullback is not just price moving against you. It is price searching for willing counterparties. In an uptrend, that means sellers. In a downtrend, that means buyers. The deeper the pullback, the more liquidity becomes available. But depth alone does not determine safety. Context does. Healthy pullbacks respect structure. They do not destroy it. In an uptrend, Price may retrace into a previous higher low, a consolidation range, or an inefficiency left behind by strong displacement. These areas are not arbitrary. They represent zones where price previously traded with balance. Balance attracts orders. Retail traders often chase price during expansion because it feels urgent. Then, when the pullback comes, they panic because they entered without a plan. The professional does the opposite. They wait during expansion and act during retracement. This waiting feels uncomfortable. It feels like missing out. That discomfort is the cost of discipline. Trends reward traders who can sit on their hands. Let us address a common psychological trap. Traders believe pullbacks mean weakness. They associate red candles with selling pressure. But in a strong trend, pullbacks are often corrective, not impulsive. The difference is visible in how price moves. Corrective moves are slower, they overlap, they lack momentum. Impulsive moves are fast, they close strongly. If price is pulling back slowly and then expanding quickly in the direction of the trend, that is strength, not weakness. Most traders ignore this difference because they are too focused on being in a trade rather than understanding the environment. Liquidity is not static, it shifts. When price retraces, stops are triggered, breakout traders are trapped, and countertrend traders enter positions. All of this creates fuel. When price turns back in the direction of the trend, it often does so violently. That violence is not randomness, it is release. Trend traders position themselves before that release. Another mistake traders make is assuming every pullback is an entry. Not all pullbacks are equal. Some are shallow, some are deep, some occur at logical areas, others occur in the middle of nowhere. This is why structure matters. Pullbacks that occur into prior highs in an uptrend are particularly important. Previous resistance often becomes support, not because of technical rules, but because traders remember price there. Memory creates orders. Institutions are aware of this memory. They exploit it. When price revisits a prior high and holds, it signals acceptance at higher prices. That acceptance often precedes continuation. Retail traders, however, often sell there because they remember rejection. They forget that acceptance changes everything. Trend trading is about reading acceptance and rejection, not drawing lines. Liquidity also explains why trends often look too obvious before continuation. The market wants participation. It wants traders to believe they are late. It wants traders to doubt. Doubt creates hesitation. Hesitation creates imbalance. Once enough liquidity is built, price moves again. This is why trying to outsmart the trend is futile. The trend is not a single move. It is a campaign. Campaigns take time. Reversal traders often argue that trend entries have poor risk to reward. This argument ignores reality. Poor risk to reward comes from poor entry timing, not from trading with the trend. When you enter at the extreme of expansion, your risk is large. When you enter during pullback into structure, risk can be tight and reward extended. The difference is patience. Trend traders are not chasing candles. They are waiting for price to come to them. This shifts power. Instead of reacting, you are selecting. This selection process reduces emotional involvement. You are no longer forced to act. You choose when conditions align. Another critical concept is failed pullbacks. In strong trends, pullbacks often fail early. Price does not retrace deeply. It barely pauses. This is not a sign of exhaustion. It is a sign of urgency. Demand is so strong that price cannot reach deeper liquidity before continuing. Retail traders often misinterpret this as manipulation. In reality, it is dominance. When pullbacks fail, it tells you the trend is accelerating. Fighting acceleration is one of the fastest ways to lose money. Trends do not end because price is extended. They end when liquidity objectives are fulfilled or opposing force overwhelms existing demand. Until then, pullbacks are invitations. The trader who understands this stops fearing them. Pullbacks are where fear transfers from professionals to amateurs. Professionals wait calmly. Amateurs panic or try to counter trade. Your job as a trend trader is not to catch every move. It is to enter where risk is defined and probability favors continuation. That requires you to accept that you will not always get the perfect entry. It also requires you to accept that sometimes price will continue without you. That is not failure. That is discipline. Most traders would rather lose money than miss out. That mindset is poison. The trend is your friend because it offers multiple opportunities. Reversals offer one chance. Miss it or mistime it, and you are wrong. Trends give you pullback after pullback until the campaign ends. This is why trend traders survive. Reversal traders either become trend traders or leave the market. By the end of this chapter, you should understand that pullbacks are not something to fear. They are something to study. They tell you about strength, urgency, and intent. If you can read pullbacks correctly, you stop guessing. You start aligning. And alignment is where consistency lives. Execution within the trend and the discipline to only take what the market offers. Most traders do not fail because they cannot see the trend. They fail because they cannot execute within it properly. They know the market is bullish, yet they buy at the worst possible prices. They know the market is bearish, yet they sell after the move has already happened. Knowledge without execution is useless. Execution is where discipline is tested. The trend gives you permission. It does not give you timing. Timing must be earned through patience, structure, and emotional control. One of the hardest lessons a trader must learn is this. Not every moment within a trend is tradable. The market offers opportunities. It does not owe you profits. When you try to force trades, you step outside the trend's protection. Most traders confuse activity with productivity. They feel uncomfortable waiting. Waiting feels like missing out. But waiting is what allows price to move into areas where risk is controllable. A trend trader waits for price to return to a level of interest. That level is not random. It is derived from prior structure, consolidation, or inefficiency created during expansion. These areas exist because price moved too quickly and did not trade efficiently. Inefficiency attracts rebalancing. Institutions are not emotional. They are methodical. When price expands strongly, they know they may need to rebalance exposure. That rebalance often happens during pullbacks. If you align your execution with that behavior, you are trading alongside them, not against them. Most retail traders execute impulsively. They see price moving and feel urgency. That urgency is emotional, not logical. Emotional urgency leads to poor entries, wide stops, and early exits. The trend trader accepts that the best trades often feel boring at entry. Price is quiet, volatility is compressed, nothing dramatic is happening. This is where professionals prepare. Execution within the trend requires restraint. You must be willing to let price come to you. That means defining levels in advance and doing nothing until they are reached. This is where many traders break. They stare at charts, waiting, and then enter early because they fear missing the move. That fear is rooted in insecurity. It is the belief that opportunity is scarce. In trending markets, opportunity is abundant. You do not need to rush. Another execution mistake is entering based on confirmation that comes too late. Traders wait for multiple candles, multiple indicators, and multiple signals. By the time they feel safe, price has already moved, their stop must be wide, and their reward is limited. Professional execution is not about feeling safe. It is about understanding risk. You are not trying to avoid losses. Losses are part of the process. You are trying to ensure that when you are wrong small. And when you are right, the trend does the work. This requires you to define invalidation clearly. Where is the idea wrong? Not where you feel uncomfortable, but where structure is violated. If that level is too far from your entry, you should not take the trade. The trend trader is selective. Another critical execution error is overconfidence after a winning streak. Trends can make traders feel invincible. Price keeps going, and every trade works. This is dangerous. Overconfidence leads to oversized positions, late entries, and ignored risk. The trend does not care about your confidence. It can pause or reverse at any time. Discipline must be constant, not conditional. Execution also means understanding when not to add positions. Many traders pyramid recklessly in trends. Adding at poor prices increases exposure without improving average entry. Smart traders add during pullbacks, not during euphoric expansion. Adding during expansion is emotional. Adding during retracement is strategic. Most traders add because they are excited. Professionals add because liquidity allows it. Execution within the trend also requires you to accept partial participation. You will not catch the entire move. Trying to do so leads to holding too long, ignoring signs of exhaustion, and giving back profits. The trend trader takes what the market offers and leaves the rest. Greed is just as destructive as fear. Another overlooked aspect of execution is trade management. In a trend, trades often move in your favor quickly, then retrace. Many traders panic during these retracements and close positions early. They forget why they entered. If your entry was aligned with the trend and structure remains intact, a retracement is not a reason to exit. It is part of the process. Exiting early because of fear turns winning trades into small wins and losing trades into emotional scars. Execution discipline means trusting your plan more than your emotions. This trust is not blind. It is earned through repetition and journaling. You must review your trades and see patterns in your behavior. Most mistakes are not technical. They are psychological. The trend exposes your weaknesses. It tests your patience, your restraint, and your humility. If you cannot execute calmly within a trend, you will never survive choppy markets. A trader who masters execution within the trend does not need to be brilliant. They need to be consistent. Consistency is built by doing the same thing over and over under similar conditions. The trend provides those conditions. By the end of this chapter, you should understand that execution is not about speed or frequency. It is about alignment and discipline. The trend opens the door. Execution determines whether you walk through it or trip at the entrance.